Welcome to StokTok's deep dive into Valero Energy. Valero is one of the largest independent petroleum refiners in the world, converting crude oil into gasoline, diesel, and other refined products for sale to wholesale and retail customers. As of May 5th, the stock is trading at $253.45. Over the past 52 weeks, Valero has ranged from a low of $115.65 to a high of $258.43. The stock is currently trading near the upper end of that range. The 50-day moving average sits at $234.47, while the 200-day moving average is at $182.98, indicating a sustained uptrend over the medium and longer term. The Relative Strength Index, or RSI, is at 61.6, suggesting neither overbought nor oversold conditions. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Valero Energy operates a network of refineries across the United States, producing high-margin refined products from crude oil feedstock. The company's competitive position rests on its asset base, operational efficiency, and access to diverse crude oil sources. Revenue flows primarily from petroleum product sales, and the company operates with relatively thin margins characteristic of the refining industry. The StokTok score for Valero sits at 55 out of 100, signaling a hold classification. Breaking this down across 5 dimensions, valuation scores a strong 17 out of 20, indicating attractive pricing multiples relative to intrinsic value. Financial health earns 16 out of 20, reflecting a solid balance sheet and adequate liquidity. Profitability scores only 6 out of 20, reflecting the low-margin nature of the refining business. Growth scores 8 out of 20, suggesting limited expansion prospects. Smart money scores 8 out of 20, indicating modest institutional appetite and insider confidence. Now, valuation. The question every investor has to answer: are you paying the right price? Valero is trading at an 18.35 times trailing 12-month earnings multiple. This is reasonable for a mature, cash-generative business, though not cheap. The forward price-to-earnings ratio, based on next year's consensus estimates, stands at 10.81 times, a significant compression that suggests either strong expected earnings growth or a market pricing in cyclical headwinds. The price-to-earnings growth ratio, or PEG, is at 0.39. A PEG below 1 typically indicates a stock trading inexpensively relative to growth expectations. The enterprise value to EBITDA multiple sits at 9.73 times. The price-to-sales ratio is 0.62 times, implying the market values the company at roughly 62 cents for every dollar of annual revenue. These multiples, taken together, suggest the market is not pricing in substantial premium for Valero's assets or market position. On the matter of competitive moat, the refining industry operates on tight margins and high capital intensity. Valero's advantage lies in its asset base and operational execution rather than pricing power or switching costs. In our view, the company has a durable but not exceptional moat. Our DCF analysis suggests the stock is trading at 0% margin of safety to intrinsic value, meaning the current price aligns precisely with our calculated fair value, implying no buffer for error or unexpected downside. Wall Street analysts covering the name have established a consensus mean price target of $258, with a low target of $181 and a high target of $300, based on 18 analyst opinions. This suggests limited downside from current levels and modest upside potential. In the most recent quarter, Valero reported earnings per share of $2.28, beating the consensus estimate of $1.77 by 56%. Revenue came in at $32.38 billion, which the market initially interpreted as a miss relative to forecasts. Operating income reached $1.73 billion, with net income of $1.26 billion. The stock declined 1% in after-hours trading following the announcement, suggesting the market had already priced in strong earnings and was focused on other factors, potentially revenue growth deceleration, guidance, or capital allocation plans. Valero's trailing 3-year revenue growth is negative 11.4%, indicating contraction over this period. However, the 5-year revenue growth is positive 17.3%, reflecting longer-term cyclicality in energy markets. Compared to major peers such as Phillips 66 and Marathon Petroleum, Valero's valuation multiples are broadly in line, though refiners as a sector have historically traded between 8 and 12 times forward earnings depending on crude spreads and utilization rates. Market sentiment around Valero leans neutral, with no strong bullish or bearish consensus in the news flow. The valuation setup, in our view, is neither stretched nor deeply attractive. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point scoring system that evaluates balance sheet quality and earnings sustainability, rates Valero at 8 out of 9. This is an excellent mark, indicating strong liquidity, profitability, and capital structure trends. The Altman Z score, a bankruptcy risk model, comes in at 4.89, well above the safe zone threshold of 2.99. This indicates negligible default risk and robust going concern status. On the liability side, Valero maintains a cash-to-debt ratio of 0.50, meaning the company holds 50 cents in cash for every dollar of debt. While this is not exceptional, it is adequate for a capital-intensive business. The debt-to-equity ratio stands at 0.48, indicating conservative leverage. The company owes less than $0.50 in debt for every dollar of shareholder equity. Interest coverage, the ratio of earnings before interest and taxes to interest expense, is at 10.4 times. This strong ratio means Valero generates more than $10 of operating income for every dollar of interest cost, providing a substantial cushion for servicing debt obligations even in a downturn. The current ratio, measuring liquid assets against current liabilities, is 1.58. This exceeds the conventional safety threshold of 1.0, indicating Valero can cover its near-term obligations with room to spare. From a credit analyst perspective, this balance sheet is well constructed. The company is not burdened by excess leverage, maintains adequate liquidity, and demonstrates financial flexibility. Valero's financial strength is a material asset in a cyclical industry subject to commodity price swings. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, or return on invested capital, which measures how effectively the company deploys shareholder and debt capital to generate earnings. Valero's return on invested capital stands at 10.81%. This is a respectable figure, above the cost of capital for most companies, but not exceptional. It suggests Valero is converting deployed capital into earnings at a moderate pace, neither creating substantial economic surplus nor destroying value. Looking at the margin stack, gross margin is 5.54%. This reflects the thin spreads inherent in petroleum refining. The company buys crude oil at global market prices and sells refined products at global market prices, with the spread captured as gross profit. An operating margin of 4.66% follows, indicating that after accounting for selling, general, and administrative expenses, the company retains roughly 4.66 cents of operating profit per revenue dollar. Net margin, the bottom line, is 3.37%. This means Valero keeps roughly $3.37 of net income for every $100 of revenue. Free cash flow margin, the percentage of revenue converted to cash available after capital expenditures, is 4.45%. This indicates the company is generating cash despite the thin net margins, a positive sign for dividend sustainability and debt repayment capacity. In context of the most recent quarter, these margins underscore that refining is a low-margin, high-volume business. The path to value creation lies in operational excellence, asset utilization, and capital discipline rather than pricing power. Return on equity, or ROE, is 17.68%, and return on assets, or ROA, is 7.07%. The gap between ROE and ROA reflects Valero's use of leverage. The company amplifies shareholder returns through moderate debt financing. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is negative 11.4%. This indicates Valero has experienced contraction over the past 3 years, likely reflecting the cyclical downturn in energy markets, lower crude oil prices, and reduced refining throughput. However, revenue growth over the past 5 years stands at positive 17.3%. This longer horizon shows that cyclicality cuts both ways. While the recent 3-year period was challenging, the 5-year view reflects recovery from the pandemic trough and prior cycle lows. Book value, or shareholder equity per share, has grown at 7.8% over the trailing 3 years. This modest growth reflects retained earnings accumulation despite the challenging operating environment. The dividend yield is 1.79%, a moderate payout that demonstrates Valero's commitment to returning capital while maintaining financial flexibility. The company has not cut its dividend despite revenue headwinds, signaling confidence in the durability of cash generation. In the context of the most recent quarter's 6.6% year-over-year revenue growth, management is navigating a recovery phase. The market reaction to the earnings release, a 1% decline despite an earnings beat, suggests investors are watching for sustained growth acceleration rather than one quarter of improvement. The setup here is cyclical recovery, not structural growth. Valero is not a growth stock. It is a cash machine operating in a cyclical industry, and investors are pricing in a return to more normalized earnings as commodity prices and refining margins stabilize. For investors seeking revenue expansion, Valero presents modest prospects. For those seeking cash generation and capital returns, the current trajectory is relevant. Now let's talk smart money. What institutional capital is actually doing with this name? Valero currently has 11 top-tier gurus holding positions in the stock, according to Dataroma, a database tracking the largest and most successful hedge fund and value investor portfolios. Among these, Christopher Bloomstrand's Semper Augustus Investments holds a 3.72% position in Valero, though the position has been reduced by 0.44% in recent activity. This suggests measured de-risking rather than an outright exit. Lee Ainsley's Maverick Capital holds a smaller 0.03% position, but has been accumulating, indicating selective buying at current levels. On a broader scale, 10% of all institutional filers tracked by standard databases are net buyers of Valero stock, meaning their aggregate position increased in the most recent filing period. This is a meaningful figure, roughly double the baseline null hypothesis, but not overwhelmingly bullish. Institutional capital is nibbling rather than rushing into the name. Insider ownership stands at 1.92%, a low figure that indicates company management and the board own very little stock personally. This is a potential warning signal. When insiders hold minimal economic interest, there is less skin in the game to align management incentives with shareholder outcomes. Over the past 3 months, insider transactions show 0 buys and 1 sell, suggesting neither confidence nor conviction from the executive team. Combined, the smart money picture is mixed. A handful of respected value investors like Bloomstrand and Ainsley maintain or are modestly adding to positions. But insider activity and the broader institutional ownership picture lack the enthusiasm one might expect from a deeply attractive opportunity. And finally, the verdict. Let's bring it all together. On valuation, the case is straightforward. Valero trades at reasonable multiples with 0 margin of safety, neither expensive nor a deep value opportunity. The forward P/E of 10.81 times and PEG of 0.39 suggest the market is not extrapolating spectacular growth, which aligns with the company's cyclical profile. Financial strength is a core asset. The Piotroski score of 8 out of 9 and Altman Z of 4.89 indicate a fortress balance sheet with minimal default risk and ample liquidity. Profitability remains challenged by industry structure. A 3.37% net margin and 10.81% return on invested capital reflect a capital-intensive, low-margin business, generating adequate but not exceptional returns on invested capital. Growth is the most concerning dimension. Negative 11.4% revenue growth over 3 years, and a lack of secular expansion drivers mean Valero is a cash generator in a mature, cyclical business, not a growth vehicle. Smart money support is tepid. 11 gurus hold the stock, but insider ownership is minimal at 1.92%, with 0 insider buys in the past 3 months. The most recent quarter's earnings beat on earnings per share, $2.28 versus $1.77, demonstrates operational prowess, yet the stock declined 1% after hours, indicating the market was pricing in that result, and is now focused on durability and forward guidance. The 6.6% year-over-year revenue growth suggests cyclical stabilization, but not structural acceleration. Our interpretation of this data is as follows. Valero Energy represents a competently managed, financially sound refinement company operating in a structurally challenged industry. The stock is appropriately priced, offering neither exceptional margin of safety nor compelling upside at current levels. This is a business for income and capital return strategies, not for growth or value with a significant margin of safety. The hold rating reflects this view. The setup is reasonable but not compelling, and investors will likely earn market rate returns with below-average volatility and a modest dividend. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Valero Energy. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.